If you guys have any questions, drop the questions in the chat box. Jeff forwards them to us, and we try to either answer them while one of us is talking, or we'll grab them at the end. So we decided to do this month on building your capital stack, which is very appropriate given the challenging economy at the moment. So this should be very enlightening. Probably some of you are already going through this. We do have people that are putting LOIs out. We've put some LOIs out. But before we put the LOIs out, it's all about building your capital stack and knowing how much it's going to cost. All right, Jeff, let's go to the next slide. John, take it.
Okay, this is my slide. So thanks everybody for joining us. Very, very quickly, a couple slides for those that are new to us. We've actually had quite a number of new folks that have signed up to join us on this webinar. So welcome. So for those who don't know who we are and what we do, we're Vision Masters. We're based here in the DFW Metroplex in Texas. And we primarily focus on both buying as well as building multifamily here in the state of Texas. We do have a few assets also in Raleigh, North Carolina, but the majority of our efforts are here in DFW, Austin, and Houston. We are boots on the ground, sponsors. We do everything from acquisitions to ongoing operations and asset management. We are involved in capital raising, both on the debt and the equity side, to capitalize a lot of these projects. We have Tandy, who's on the call today, who is heading up all of our efforts around the accounting and making sure that all of the books are in order for all of our different properties. We do marketing, public relations. We're involved in construction, both in terms of ground up for our new development projects, but also rehabbing and putting our CapEx plans in place for all of our properties. We have an in-house investor portal for those investors that are on the call tonight. You're well aware that we have our own in-house investor portal where folks can access property financials, K1s, investor reports, etc. And then finally, but most importantly, I guess, we've got the legal team. Merrill will introduce himself in a minute, but we have, our SEC and real estate team that helps us with all of our syndication work, PPM, subscription docs, etc. Next slide, please. So Merrill and I have known each other for many, many years, but about a year and a half ago, we kind of just got together and saw that there were a lot of kind of synergies with regards to how we think about business and family, and with alignment around integrity and ethics. With complementary skill sets, we said, you know what, let's do a couple deals together. We'll see how that goes. And fast forward about a year and a half later, bringing on Anna and Bernard, who will introduce themselves in a minute, as well as our extended team with Andrew Lee with asset management, Jeff, who's running the show here, is head of all of our operations, and then Tandy in charge of all of our finance and accounting. We've really kind of scaled up fairly quickly. This is just a summary of what we've done. So on the white boxes, those are for existing multifamily deals. We, in the last year and a half, closed on 26 multifamily deals, averaging 211 doors per asset, totaling 4,400 units in 15 different cities across Texas and in Raleigh. We raised with a lot of our capital partners, $165 million for A and B class assets with an average build vintage of 1983. On the blue boxes on the right, those are our new construction projects that we're involved in. We have 8, actually it's now 9 different multifamily residential development projects that we are working on the ground up in 7 cities across Texas, with the estimated stabilized value, once we've built all of the apartment communities and got them stabilized and leased up, in a value of $1.6 billion. So it's been a great ride. We couldn't have done it with our internal team or without all of our investor partners, many of who are joining us this evening. Next slide, please. So since I'm talking, I'll just kind of wrap up here. My name's John Montero. I'm the second from the left, based here in Frisco, Texas. Moved to Frisco in 2009, so been here for well over a decade now. Moved here from Hawaii and the Bay Area in California for opportunity. And it's been a great move for myself and my family. And doing full-time real estate, really enjoy what we're doing and adding value to a lot of different parties, whether it's our teams, whether it's our investors, or our third-party vendors. Just really enjoying what we do on a day-to-day basis. So with that said, I'll hand it over to Merrill.
Hey guys, Merrill Calliser. Those of you who don't know me, I'm a commercial real estate SEC lawyer. Got a firm, Calliser and Associates, with Cindy Merlis and Greg as associates of ours. They work on a lot of our deals. We represent about 300 plus transactions a year that are either buying or selling multifamily storage strip centers. And then I've been in the Dallas area a little bit longer than John, since 1975, which is kind of weird because that makes me -10. But I've been here quite a while, and so I probably have seen more growth occur than anybody. It's kind of scary. Where I live right now used to be a cow pasture we would go park cars on in high school. Never thought that there'd actually be a 25-year-old house here. Again, the numbers don't make sense to me. But anyway, John already told the story between he and I. I was doing single family with Jeff Satz, who's up here. We were aggregating single family for about 7 or 8 years, had thousands of doors, and decided did not need doors spread out all over the United States. We'd rather have 300 or 400 doors on the corner, like clients. And John helped convince me to go to the dark side and start compressing doors. And as he said, it's been a wild 18 months. I'm very excited, and excited to introduce Bernard from Old Canada.
Thanks, Merrill. So my name is Bernard Kozik. I'm, like Merrill said, originally from Canada, but I am transitioning down to Dallas. My background is a bean counter, an accountant, chartered CPA. Background also in investment banking, spent a couple of years there. Went on to the buy side with Brookfield Asset Management and their property group in New York. That's where kind of the exposure was to a lot of institutional investors, a lot of large pensions, foundations, family offices. And then circa 2016, we developed our own shop up in Canada for development, opportunistic. And then we obviously saw an opportunity that lots have been seeing in multifamily in Texas, and decided to make the switch more than over about 6 to 8 months ago. That would be a good opportunity for the long term. So I'll pass it over to Anna to introduce herself.
Great. I'm Anna Kelly, and I have a background as well on the institutional side. I started out in private banking back in 1998, and then worked for AIG for ultra high net worth investor products, onshore, offshore private placements, and started investing in real estate on the side. I developed a couple of 100 units and then started doing joint ventures and syndications. And now I'm a full-time syndicator, and joining up with Merrill and John and Bernard, and happy to be a part of Revision Masters.
I want to clarify something real quick, because you guys know I like to make jokes and have fun. Just to clarify, Bernard is not moving down here to transition. He said he was transitioning down here in Texas. He's actually moving to Texas still as Bernard, and he will be here as Bernard. So just want to make sure. Not that there's anything wrong with that. Just want to clarify that.
Thank you for that legal clarification.
Yeah, you're Canadian. Sometimes it's different. So I'm going to talk real quick about building your capital stack. Some of you may have heard this before. I've done this a couple times in the last 2 years. But basically, building your capital stack is like very similar to making a fine bottle of wine, where you've got to blend several different varietals, and just get that right mix. And so, especially now when the capital stack, I don't know if it's more difficult, but it's definitely more complicated with what's going on in the economy. You really need to look at what you're going to do with your capital stack before you even put an LOI out. And this is something we're talking to clients about right now. Traditionally, your biggest portion of your capital stack is what you see in orange, debt. This is an older slide because I don't think anybody can get debt for 4% today. But typically debt is going to be in the 60 to 70% range. Again, right now, it may be a little different, maybe 55 to 60, but typically it's 60 to 70, maybe 75, excuse me. And debt is going to be your cheapest form of capital. So traditionally, we all try to get the maximum amount of debt we can, subject to whatever our risk tolerances are, because that's going to be your cheapest form of capital. It's secured by the property. Sometimes there's personal guarantees. There are a lot more personal guarantees now than there were a year ago. So again, you have to adjust this for your risk profile. And then the middle piece, right here, I have it as preferred equity. Preferred equity, it could be joint venture, it could be preferred equity, JVLP, family office. It could even be a mezzanine, which is a second position debt, or it could be, if you're doing construction, a CPACE loan, which sits on top of debt. So it's funny as I look at these numbers, because again, pref equity, you're not going to find 6% right now, but 12 to 14%, maybe 15% is pretty traditional for pref equity. But John and I have seen some quotes. We did not move forward on these quotes on bridge for a construction loan, and the bridge for the construction loan is not far off of the 14% rate for pref equity. So it's interesting to see how kind of the first and middle in some aspects has kind of combined itself. And then your top piece is your common equity. We refer to it as like syndication. You're going to go out and you're getting the regular, I don't like to use the word mom and pop, but they're non-institutional investors. And typically, traditionally, people are trying to give their investors or pro forma their investors an 18 to 22% return. So that's going to be your most expensive capital. So from least to most, it's debt, then either a preferred equity tranche. You don't have to have preferred equity. It's just, if you use it, that's another way to blend your cost down a little bit. And I'll show a slide at the very end that talks about how you blend it. But let's go ahead and talk about debt real quick, Jeff. Can you go to slide 6? So debt options. Most of you already know this, and some of this has changed over the last 6 months. The group that we know for sure is lending is agency. Agency, Freddie, Fannie, USDA, and HUD are all open for business. However, you may not like their terms, and not that their terms are bad, but their appraisals may come in lower, their loan to costs may have a lower percent than what you may be used to, but you can get some fixed product with Freddie and Fannie. If you're doing a new development, you can go the HUD route. John and I have chosen not to go the HUD route this far. There's a lot of reasons. HUD is a great option if you're going to hold on to the asset and that's your exit strategy. Otherwise, you've got a 10-year step down on most HUD products, and you're locked in at the rate. Now, we would have liked to have been locked in at a rate a year and a half ago, but taking something like HUD today, depending on how your economics look, you may not want to be locked in at a rate that is 6 or 6.5, whatever HUD is going today, with the presumption that at some point, either Q4 or Q1 or Q2 next year, the Fed's going to do an about face, as they have every kind of recession, and start dropping rates. Well, now all of a sudden you're stuck at the higher rate, which worked. But anyway, HUD can and can't be good. CMBS, John and I have listened to several speakers on CMBS. I'm sure there'll be some people that are going to correct me, but for the most part, CMBS is kind of shut down right now. They're kind of waiting to see what the Fed is going to do. There may be a few CMBS lenders out there, but for the most part, they seem to be pretty shut down right now. Community banks and credit unions. So if you've got a smaller asset that you're looking at, typically 20 million or less, maybe 25, depending on the credit union or community bank, you're probably going to get pretty decent terms compared to everything out there today if you can find a community bank or credit union that is in your market, for understands your market. So if you live in Hershey, Pennsylvania, like Anna, and they have a Cocoa Puff credit union up there that may be part of Hershey. I don't know. I'm just making that up. They're more likely to look at Anna's deal before they would look at a deal that maybe John and I were doing by ourselves in McKinney, Texas. So that's something that people should be looking at right now and developing relationships with. Bridge lenders are out there. They were everybody's favorite 2 years ago, and now they're everybody's nightmare now. That's a whole nother webinar that I'll talk about. What's going on with some of the bridge lenders. They're just protecting themselves, but they're exercising clauses that nobody had ever thought they would exercise in the last 5 years. But Bridge is still out there. John and I get some very interesting and entertaining quotes from Bridge, anywhere from SOFR plus 450, which is 4.5 points, and SOFR's at 4.75 today, all the way up to SOFR plus, what are we seeing, 950? 950, so that's a 13.5% loan. But it was nice, one of that 13.5%, no personal guarantees, which is a good thing because there's no way to make that deal work. And the other thing that we're actually seeing some clients do, they're taking advantage of some life insurance companies. So it's typical in markets where something becomes really tight, a segment of the service industry becomes very tight, other groups open up and fill that gap. So where you have some of the lenders falling off, you've got insurance companies that have always been around, but are being a little more aggressive and want to park money. So when you're talking to your debt brokers, I would encourage you to ask them about any life insurance company options, community bank, credit union options. Again, if there's CMBS, that's great. Just haven't seen a whole lot of that moving around. Next slide, 7. Okay, times have changed. Thank God nobody here listened to me speak yesterday at the conference we were at. I basically told everybody that they should relax and not be so upset because we all thought we were going to die 2.5 years ago with COVID and the world was going to shut down and everybody had their best year ever. So yeah, things look bleak, but stick around. It's like the Texas weather. If you stick around, it will change and everybody will get through this. But just to recap, pre-COVID to first quarter 2022, debt was the easiest part of the capital stack to obtain. I challenge anybody to send me a message stating that debt is the easiest thing to obtain right now. The Fed rate was between 1/4 and 1.5%. Cap rates were relatively low. Actually, they were very low. Greater valuations for assets. Just about everything out there was non-recourse, which is kind of flipped. Now, a vast majority is recourse unless you're going agency. And the loan to costs pre-COVID were 70 to 80%. You could get up to 80% if you wanted it. Then we fast forward to Q2 of last year, that everybody is very well aware of. I call it the Fed's shenanigans. Most debt is the most difficult part of the capital stack, especially if you're trying to do construction right now. Agency is the best option for an interest rate cap, though you can get some floating agency. Currently, the lowest, this is with respect to agency, it's the lowest loan to cost that we're seeing because they're trying to protect their back end. So that could be an issue. And keep in mind, agency typically has a defeasance or prepay or step down prepayment penalty that you have to be aware of. So if you want to, you have to be very careful and just discuss this with your debt broker. You know, if you're getting into an agency loan and your plan is to exit in 3 years and you're in a 7-year Fannie or Freddie, more likely than not, the interest rate will be less in 2 or 3 years than it is right now. It'll go up another 0.5 point or 3/4, and then it'll eventually start to drop. But when you try to get out of that loan, you're going to have a very costly payment to get out of there. So if your goal is to hold on to it for 7 years or the length of the loan, that's great. So Bridge is still out there. Again, this is a little bit older slide. I put 350 to 675. It's more like 450 to all the way 950 basis points. For those of you who don't know, 100 basis points equals 1%. So we're seeing Bridge typically in the range of 9.5 to 13.5, 14.5%. We're seeing bank loans coming in at Wall Street Journal plus anywhere from 0.5 point to 1 point. Wall Street Journal's at 7.75 right now, so that puts those in between 8.25% and 9% plus or minus. Most bridge and lenders right now are asking for 12 months of interest escrowed. They're asking for either partial recourse or full recourse. I don't think there's anybody on this call that doesn't know what a rate cap purchase is. That's kind of what's causing most of us not to be able to do distributions. A tiny little provision that the bridge lenders have never exercised or all exercising 1 year before your rate lock is expired. They can require you to buy another rate lock and start escrowing funds. And just a little anecdote, I'm going to keep it short because I have a bet going with John. We have a deal that we had a 1% rate lock we bought in 2021, January of 2021. And we were complaining because we locked in, I think it was about a 30-something million loan at 1%. Because back then the rate was a quarter. There's no way it's going to go higher than 1. And we were debating, should we lock in for 3 years for 130,000 or 1 year for 82, or 3 years for maybe it was 180 and 1 year for 2 years for 82. And so we talked about, we're like, let's do 2 years for 82. Well, guess what? We're coming up on our 1 year anniversary next January, and we've been escrowing for the new payment, which went from 82,000 to 1.2 million. So that is why you see and why a lot of our clients are unable to make distributions right now, not necessarily because the assets aren't doing well. It's because the provisions in your loan docs require you to buy another rate lock. And then I have a little note just to annoy some of the lenders that might be on, or some of the brokers, but even with bridge, there's no guarantee bridge is going to close, especially right now. So you've heard John and I talk about it. Always have plan A, B, C, D, E, and F, because you never know. John, I'll pass the baton to you. Next slide.
All right, thanks, Merrill. And that's a good segue. Talking about having a plan B, C, D, and E. What are we doing today at Revision Masters with regards to debt strategy based on all of the challenges that we're seeing in the debt markets currently? So the first thing that we're doing is we're casting a wide net. And basically all that means is we're talking to a lot of different lenders out there to see who's in the market, who's lending, who's not lending, who's pencils down, who's waiting until the Fed stops raising rates, and then they're going to assess at that point, and who is still, understanding the fundamentals of a lot of the assets that we're looking to either buy or build, regardless of whether the Fed is going to continue to hike interest rates or not. The fundamentals of all the population and job growth and the lack of housing that we're seeing in the markets that we are, again, building and buying in. Some of these lenders understand that those fundamentals are still strong. So there are lenders that are still in the market to lend. We just have to work a little bit harder to identify who those are, continue to build those relationships, and see if we can get these projects capitalized. So, with regards to casting that wide net, as I'd mentioned earlier, we have two verticals. One is building ground up apartment communities, and the other is we buy existing A and B class assets and execute a value add business plan around those. So the next two bullet points, the middle one there is regarding new development. So one of the strategies that we're implementing now for our new development projects is that we are implementing what's called an A&D strategy for our new development projects. And what A&D basically stands for is the acquisition and development of the new developments projects. So acquisition of the land, and the D stands for the development or the horizontal development of our new development projects, our ground up projects. And so that's a strategy where we're able to buy the land with permits in hand and do all the horizontal dirt work, do all the internal roads, do all the utilities. And that's going to basically kind of put us into the back half of the year before we can then do a new construction loan to go vertical. So again, in new development, you've got the horizontal piece, and then the second phase is to go vertical and build the vertical buildings and get them leased up and stabilized. So again, one of the strategies that we're implementing with all of our new developments right now is we're working with lenders to buy the land on the A side, and then on the D side, they're helping us fund our projects to do all the horizontal work, which will then kind of put us in the back half of the year. We think at the back half of the year, hopefully the Fed will have stopped raising rates, markets will have settled down a little bit, spreads will have narrowed, and more lenders will be back in the market. So we think that'll be a more healthy lending environment towards the back half of the year. So that's what we're doing on the new development side. On the existing side, we're always looking and underwriting deals. Anna, Merrill, and I have spent the last couple of weeks actually underwriting a 3-pack here in Texas, 3 different property portfolio. And one of the things that we're looking for are loan assumptions. So these are deals which has typically a fixed rate loan, typically a pretty strong rate of, this particular example was a 3.6% interest rate, which in today's market is extremely favorable and attractive. And it was fixed. So it's fixed for an extended period of time. So if we can work with sellers that have these type of loans that are assumable and help us with that blended, bottom of the capital stack, as Merrill had mentioned earlier, those are definitely opportunities that we're looking for as well. So those are kind of our high level strategies, kind of navigating this very interesting debt market in today's environment. Next slide. I think Bernard's next.
Thank you, John. So we'll pivot out now over to some of the capital markets in terms of other investors and institutional other pools of capital. So basically, this what this slide illustrates, when you look at your different quadrants, you've got debt, equity, public, private. This looks at the private capital markets, and what that basically means, debt and equity. But on the right-hand side, all of these players, the endowments, the foundations, the pensions, they all provide equity. Some of them provide debt and equity. So what we're trying to build out at Revision Masters is to attach not only the projects to the capital that we need going forward for the pipeline, is to build out the institutional investor platform. So you might think of what is an institutional investor? I mean, these are endowments that you might have at universities, foundations that you find across the country. On the pension side, you have both public and private pensions, all the way out from Dow Chemical to the smaller pensions at Oklahoma teachers. You have family offices. These could be single generation family office that has come up because it needs sort of the personal CFO attention. And that includes anything from will writing to tax strategy to investment advice. And then you have multi-family offices who manage anybody from sports franchises of the Dallas Cowboys to movie stars or what have you, and they manage different pools of capital. You have individual investors, what is known as traditionally retail investors. And then you have insurance companies, banks. So that entire sort of right quadrant is what is known in the industry as the buy side. They're the people with the money, and they have to deploy the money to generate a return. Sometimes it goes through money managers or fund of funds. Other times it goes directly into the asset managers or traditionally owner operators. And then they put up additional of their own commitments, smaller portions, obviously, and they deploy them into assets or firms that own real estate assets in this instance. So this slide basically illustrates who's got the capital, where is it flowing, and then the relationships that need to be forged and developed with the buy side. Okay, Jeff, next slide. So the question then becomes, okay, well, what are they looking for? Well, it's not everything for everybody. So there's focused nationwide and global sponsors. So there's sponsors that offer verticals and investment availability into industrial, multifamily, office. Some buy-side institutional investors might be looking for an asset manager that only does multifamily and only in a certain state. But some of them look for a broad diversification across different platforms, different asset classes. So it really depends on what they're looking for, where they want to deploy their capital, whether that's, it could be in private equity, it could be in real estate, it could be different alternatives, or it could be in public markets, in equities or fixed income. Track record, that's a no-brainer. They look for track record almost across every single asset manager that's out there. And then they ask themselves, okay, what is this asset manager? What kind of a competitive advantage does he have over others that in this industry? So, the operating platform, the type of infrastructure, the team that they have, do they have the financial strength? Have they done this before? Do our interests align? Are they ethical, transparent? All of these bullets they look for in terms of whether they're going to obviously deploy any sorts of larger checks. A family office can deploy anywhere from $1 million to 500. A pension, their equity checks are a little bit larger. They're minimum of 50 and upwards to 300 million. So it really depends on the breadth and the depth of the institutional player. And then they also look for, well, what's this platform doing? Where have they been? Where are they going? Is there their growth? Is there liquidity here? Strong cash flow that they've generated? And are they looking in areas where, the asset classes are in demand? Multifamily is a great asset class. It's been a great asset class for many, many years, and it will continue to be. So all of these bullets, all of these points will dictate whether an institutional investor will look for in a sponsor and what they're going to actually deploy the capital to. Okay, next slide, Jeff. And then, they always ask themselves, a lot of people ask, what are the typical terms that institutionals look for? They're in the industry is what is known as, and Meryl likes to say this, keep it simple. And it is keep it simple, because a lot of the fees that are thrown out there are, they should be on the same basis. So, on the retail end, for example, you have an asset management fee, but that's calculated on revenue. In the institutional side, it's either invested or committed capital that you're charging the asset management fee. So it's a little bit of a different basis, but if we go out there and talk to for example, an endowment or a foundation, and we just say, yeah, we charge a 2% asset management fee on, and then we don't say the actual basis that we're doing, they're going to assume it's either committed or invested. So that'd be definitely a larger number than on total revenue. So you have to make sure that the audience and the institutional side, you're talking a little bit of a different language and different terms. They look for a carry split on the waterfall, usually 80-20 over a 7 to 9 pref. And some of them do a catch up. On the value add side, it's anything over 11 IRR, and on the actual opportunistic, which is traditionally considered in the industry as development, being an opportunistic because it generates a much higher return, as it obviously a higher risk that the asset manager needs to mitigate. Typically the net IRR, they talk a lot in IRR terms, not on average annual returns. On the value add side, depending on where you are in the economic cycle, it's kind of, your goalposts are 12 to 18% on a net basis after fees. And on the development side, it's 18 plus and up to compensate for the higher return. Okay, next slide, Jeff. And then the typical process of how we generate it's networking. It's a lot of frog kissing, as you can imagine, and you basically, the process is you got to intro the firm, intro the track record. You got to provide who's on your bench, who's on the team. What are the projects that you guys are looking at? Are you active? Are you sitting still? And it's relationships. That's what it boils down to. And after a good chunk of frog kissing, you'll eventually move into to make that transition into meeting the demand for the capital with the great assets that we have on our platform. And I'll turn it over to Anna to talk about syndications.
Great, thanks, Bernard. Okay, so the syndication piece is essentially the part where we're reaching out to other investors, private investors that are not on the institutional side that Bernard spoke to us about. And so typically, a syndication is simply us providing group opportunities for passive investors, where we're the general partners, we're the asset managers, we are the ones that are active in the deal and producing the return, and the ones that also are on the hook for the liability for the debt. So we have our reputational risk, and as well as risk on the net worth and the liquidity and the execution risk. And then the limited partners that we bring into our syndications, many of you are syndicators, many of you might be a limited partner, are those that are truly investing passively for a return with no active responsibilities and no liability for the debt. Typically, when we're syndicating our multifamily assets and really any type of commercial real estate, we're looking at two different types of syndications, either 506B or 506C, and they cause a lot of confusion, especially for a lot of newer syndicators. But essentially, 506B syndications are those where we ask for accredited investors, and we can have up to 35 non-accredited investors. A lot of newer syndicators use 506B primarily. The difficulty with that is with 506B, although you can bring in investors who are not accredited, meaning they have $200,000 to $300,000 in income and at least $1 million net worth, not including their home. If they're not accredited, you cannot advertise that deal in any way on social media. You can't ask for investors, and you have to show the SEC that you have a pre-existing relationship, a pre-existing substantive relationship with any investors that you bring into your deal. 506C investments, on the other hand, are basically deals that we only reach out and allow accredited investors to invest in. The SEC does require us to get third-party verification of being accredited, having the net worth or the income to qualify as an accredited investor. And these deals, the benefits as a syndicator is that we can advertise the deal. We can talk to many people about it, and we don't have to have a pre-existing relationship to allow someone to invest in our deals. With syndications, there's generally general partners and limited partners. And typically what we see in the multifamily space is the general partnership has 20 to 30%. It's more heavily unusual 30% ownership, and the limited partners have 70 to 80% ownership in those deals, in the cash flow and in the back end, depending on waterfalls and depending on private equity and the lenders that you have in the deal as well. And typically limited partners are looking for target returns somewhere in the 15 to 20% average annualized return range. And again, that's subject to market conditions. So as Meryl talked about earlier on, when debt is cheap and interest rates are very low, it's very difficult to make a very good return on things like US Treasuries. And so as people move up that risk premium ladder, they want higher returns for higher risk. And so we see kind of that 15 to 20% that most limited partners are expecting. And again, as market conditions change, those return expectations change as well. And typically we're looking at deals where we can provide passive investors, the limited partners, somewhere between a 7 and a 10 preferred rate of return. And that's generally the cash on cash return that we're trying to pay out through the operations. And if we don't pay out that amount of return during a particular year, especially as we're value adding and taking a couple of years often to renovate and raise the value, sometimes those preferred returns aren't actually met in any particular year. The preferred return means that you have a catch-up provision where essentially before the general partners take a split of that cash flow or upon sale, we're basically making sure that we catch up that provision to where the average cash on cash return is that 7 to 10 pref range. And again, that's going to vary. The range is really going to vary a lot depending on the location, the asset class, whether it's an A, B, or C asset. They generate different types of cash flow, different types of risk, the investment strategy, and also the amount invested. So the more invested in our syndications, typically the larger preferred return we pay out in exchange for that larger investment. Next slide, Jeff. So now more than ever, blending your capital stack, as Meryl said, is like blending wine, like aging like a fine wine, like Meryl, right? So we like to talk about blending the capital stack. And basically what this means is we take into account all the things that we've talked about on this webinar so far, the debt that we're going to be able to get on a particular project, the preferred equity that might be available on a particular project, and what type of returns the preferred equity expects, and then the private capital, the limited partnerships, and how much we're going to have to pay in returns in order to get investors to want to invest in the particular project. And so when we're looking at debt, we've got to figure out, what are the rates? How high are they? Is it recourse or non-recourse? And typically a lot of lenders that were offering non-recourse loans are now, charging much higher rates, and they're also wanting the general partnership to sign on those loans. We look at whether it's fixed or floating debt, and those can really make a big difference in the rate that we end up paying for the debt that we're borrowing against the properties. We have to look at whether the lender is going to require a large amount of interest reserves set aside on the side, in addition to the down payment that we might need to come up with. And it's really important, as Meryl talked about, to really understand the terms of the loans that you're getting, because the rate is not the end all be all. And sometimes there are provisions that people really take for granted and don't read their loan documents, like having to maintain your LTV or maintain your debt coverage ratio over time. Even if that variable rate changes or LTVs come down, the lenders can actually pull your loan, or they can require capital calls and make you pay down that loan over time. So you've got to really look at the debt very, very carefully and determine what is that LTV that you want to go for, and at what rate, given the provisions and the risks of having that debt. And you want to look at whether they can hold back escrowed CapEx. So for example, you're renovating properties and projects, and you submit your receipts to the lender, they don't have to pay you back right away. So you want to really make sure that you understand the provisions of that debt in addition to the rates. And then depending on the LTV, and I think Meryl said this early on, not only are rates going up, but lenders are providing a much lower LTV today than they were 6 months ago or even a year ago. And even if they advertise 75 or 80%, when they actually underwrite your deals, often they're coming back 55, 60, 61%. If you're really lucky, maybe 65% LTV. And so you're having to raise a lot more money in terms of your capital stack, more money from private equity, more money from your limited partners. So when you're looking at private equity, you want to look at them very similarly in terms of all of the provisions they're requiring in order to become a private equity partner. So they have oftentimes very much terms like a lender. Some of them want to be able to have a lot more control than you as a syndicator might want to give up. They might have a provision allowing them to remove you as the general partners on a particular deal. And they might have terms that will trigger full recourse or certain types of default. So it's really important that you understand those terms really well. Jeff, next slide.
Hey, Jeff, go back one slide real quick. So I'm just gonna, I'm the last slide. So you guys are lucky you don't have to hear that much of me, but I did want to add to what Anna was saying. I think I made the mistake of posting something about what we were going to talk next month on. It would include capital calls and loans to the partnership, and I got quite a bit of direct messages regarding that. But this kind of goes back to what Anna was just talking about. It is so important for you to, and I'm not just saying this as a lawyer, but to be in contact with your counsel when you're going through loan docs. There are tiny little provisions that you need to understand. You know, if you've got a cash collateral account that is set up, which is happening all the time now. If you don't meet your debt service coverage ratio, they just trigger a cash pedal. It sounds horrible. It's not as horrible as it sounds, but it means basically the bank gets all the receivables that come in and they pay their mortgage. Then after that, you can pay your bills, but the bank's going to control the cash account until your debt service coverage ratio goes up. a lot of people don't know that got, well, a lot of people do know as of 2 weeks ago, but that have bridge debt, that the bridge lender can change the SOFR definition on you with typically 2 weeks or 30 days notice. And so we had quite a few clients that just got their SOFR changed from term SOFR, which is at 4.75, to I believe it's 30-day SOFR. 30-day SOFR is I think it's 30-day SOFR. I can't remember the exact term, but it's a look forward. What do the banks think SOFR is going to be in the next 30 days? And if you're watching the news, whether the banks are right or not, they think it's going to be higher than it is today, a quarter to 50 basis points. So they take 80%, they take 80% of what the banks think, and that's the new rate. So we have clients that as of 30 days notice, all of a sudden just got their rate bumped by 50 basis points. And the downside with that is your documents don't say that if the look forward is going down, that you get to benefit on the downside. No, there's no benefit on the downside. Your floor is set way up here. So there's not a whole lot you can do, but you just need to be aware that some of those provisions are in there. So it's very important to read the docs. And then if you're already in the thick of things and you're escrowing for, or you're trying to escrow for a rate lock and you're having capital issues, you need to talk to your lawyers. You need to not ignore the lender. The worst thing you can do is ignore your lender or your pref equity group, especially pref equity. We loved pref equity when they came in, but pref equity was like something I used to do a long time ago, hard money lending. They're loan to own. Don't give them a reason to want to take the property back. Now, they may not want to take all these properties back, but don't give them a reason. If you are communicating regularly with them, as you should be with your LPs, nothing should come as a surprise. They do understand what's going on, and you show them this is how you're asset managing. We've heard it time and time again, and we've talked about it forever. You've got to be the best asset manager you can. You've got to make sure you've got an entire team that is there to help your property management company. They can't do it all. And we put a lot of pressure on property management companies, especially when the market gets a little tight. So you've got to go in and you've got to be cognizant of it. So now we'll go to the next slide. This is actually fun. So this is actually how you blend your wine. You take a little bit of Cab, a little bit of Sauvignon Blanc, but basically, I've done this a few times. You just want to see what is your cost of capital for every dollar that you need to buy and operate this. What does that cost you? So I want to buy 123 Main Street. So every dollar I spend is going to cost me how much? In the first example, I just gave some scenarios. If you're interested, send me an email. It's a very simple spreadsheet that I put together. You got debt at 8%, you got pref equity at 14%, you got private capital at 20%. Those are the rates. And then looking at the middle column, this is exhibit B. Somehow I lost A and D out of this. But if you're looking at the middle column, that's a 70% for your debt, 15% for your pref equity, 15% for private capital. This is more like a deal a year ago, except the debt seems high. And then you're multiplying that number all the way across to get a blended and average cost of capital. So for every dollar I'm going to need to buy this asset and put CapEx into it, it costs me 10.7 cents every year. That's not a one time. If I hold it for 5 years, it's costing me over 50%, which is fine because you've got a pro forma, presumably, where you're controlling your expenses and adding a value or other income or natural appreciation based on market conditions. And so then you can go from exhibit B to then looking at exhibit C, which is a little more reasonable in my mind if you can find debt at a lower rate. And if you can find pref equity, if you're going to use pref equity at a little lower rate. And then you can use private capital at a little lower rate. Say private capital comes in, your investors are willing to take 18% versus 20. People have a very short-term memory. 5 years ago, 12 to 16% was actually a good return for investors. It's probably a good return for just about everybody on the call at the moment. but it just depends on what you can negotiate. You need to be thinking about this. So that's 9.6% blended capital. And so I'm talking dollars right now. So for every dollar I need, it's 9.6%. But what if I need $20 million? Okay, so now I put real numbers. This asset, and that's a small asset. I don't think we've bought anything that's under $20 million in a while, but just so you understand the numbers, I went over example B. So if I am funding that $20 million asset with the blend under example B, that costs me $2.3 million a year between private capital, pref equity, and debt. If I'm doing that same project and I'm able to find better terms and I can get a blend under example E, that costs me $1.9 million for the exact same asset. So while 400,000 may not sound like a lot of money, if you hold that asset for 5 years, that's $2 million. Where do you think that $2 million is going to go? Well, 70% is going to go to the investors. So they're going to have an extra, 70% of $2 million, they're going to have $1.4 million extra in return. And then of course, you as the GP, you're going to make more money. So it's advantageous to, if you can, shop and constantly be in contact, especially now, with your debt broker or your mortgage broker, and find out what options are out there. And then you need to be constantly newsletter, emails, whatever, to your investor database. You need to know what they're thinking. If your investor database has 90% of the people saying, hey, we're pencils down, we're scared, blah, 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 don't go out and buy an asset unless you have a backup for equity. You've got to really understand what's going on. So that is it for me. Jeff, there's one more slide. John, is this one you? You're on mute.
Sorry about that. Yep, I can go over this last slide. So for those of you that have been dialing in, this is our third webinar, educational webinar. Our next one will be next month. We'll get that out to you in an email, but we want to be talking about asset management next month. During these times around the different changes with the debt and the floating rates and the escrows for the interest rate caps, it's becoming even more important to make sure that we as sponsors are doing a really good job kind of asset managing on a day-to-day, week-to-week basis with our property management teams. And so what we wanted to share next month is kind of the importance of doing all of that, and show some examples of some of the reporting that Jeff has been able to put together, our dashboards around how we effectively manage our assets with our property management teams. And then Andrew Lee, who is our asset manager, will be joining us as well to kind of talk about, how he kind of manages those weekly meetings with our property management teams, looking at the metrics, the dashboards, the KPIs, so that we can kind of create effective action, proactive action to maximize the revenues and drive NOI. So looking forward to next month's session. With that, I think we'll just open it up for some Q&A.
I can go over a few of the questions. Most of them are about capital calls. So we had a question about the escrow. We're talking about lenders requiring you to start escrowing monthly payments for a future rate lock. Typically, it's 1 year in advance. And the question is, are the higher escrow cap lock purchases only held in escrow so that when the property is sold, escrow is returned, or those higher cap lock purchases are kept by the lender, therefore reducing investor returns? So there's a little confusion here. So the lender really has nothing to do with the cap lock, other than the lender wants to make sure you have money sitting aside so that you, sponsor, can go buy the cap lock. The lender doesn't sell you the rate lock. So it's an insurance, it's basically like an insurance product where you go and You get on the phone, it's actually pretty funny. It's almost like you're buying a stock, and they lock you in right there, almost like when you're locking in your rate for your loan. So two things. One, the lender is not the one that's going to go out and buy it, but the lender is going to require, they've already got an estimate of what they think it's going to cost. It could cost less. In 12 months, most likely it will cost less. But for right now, that's what they think. Now, on the flip side, there are a couple things. If you go and sell the property before the lender has, before your time to buy the rate lock has come and you've got to use that money gets refunded to you, 100% of it. That's your money. So you didn't have to use the rate lock, because let's say ours is due in January 31 of 2024, and we sell our property January 15th, or let's make it a little earlier, January 1st. So the 11 months of escrowed money to buy the rate lock comes right back to us. And on top of that, some of you who are LPs might be worried, oh God, so that money that could have been distributed to us is now going to buy another interest lock. Well, yes, but another way to think of it is it's a great time to sell the property after you lock in on a fixed rate, January 24th. So essentially we would be locking in on our deal. We're locking in at like 3.8%. And so there would be a lot of people on this call right now that would love to have a 3.8% fixed interest rate for the next 2 years, thanks to us for buying the rate lock. And because we bought the rate lock and we're able to provide the debt to someone who assumes it, hypothetically, we're going to charge more. Okay, so we're going to get that money back, maybe not 100% of it back, but we're going to charge more. And sponsors, including us, we just underwrote a deal that was a smoking deal. We will pay a little more for that really nice rate lock. So don't get too hung up on the escrows. I know it sucks, but you know it's happening across the board. Let's see. Nobody wants me to talk about cash calls. That's pretty funny. What recommendations do you give to GPs about cash calls and LPs about cash calls? I wonder what's on everybody's mind. I'd rather prefer you don't talk about capital calls. That was good. I'm just going through the questions. Apparently nobody wanted to hear what anybody else had to say. They like the surprise. So we don't really have any questions regarding what we talked about. There's a question, Bernard, this might be helpful for you. What is the best way to connect with family offices, etc., for a new syndicator with limited experience? I think you're going to know the answer to that real quick.
Yeah, I mean, look, it's it's not an easy process. I mean, if you do have a track record, and I'm talking about, don't start off with, the big guns, the pensions, the endowments. They probably won't even answer your email like a bad broker. You want to target sort of smaller family office, single family office, that you develop a relationship, you keep in touch with them over time, and then once you nurture that relationship for, I would say, probably over 12 months is when they'll start to look at deals with you. But that's high net worth area in single family office is probably the best first step. Fund of funds are also good. But you have to develop that relationship. You have to show them the track record. I mean, basically, it's just demonstrating competency at the end of the day. And then once you do that, then you can kind of, attach the family office pool crowd. It's a very large capital pool in the US. I think it's close to $4 trillion, if I'm not mistaken. It's a very big pool. And I wouldn't touch the multifamily office, because those are, second, third, fourth gen family offices that have, they're the sons of the original founder of the family office. So, target single family offices at the beginning, establish that track record, that relationship with them, and then they'll most likely commit some capital to you.
That was That was a good question. As an example, the three of us, myself, John, and Bernard, we attended a seminar a couple weeks ago with a bunch of pension funds for what they called emerging capital, emerging sponsors, essentially. And so it's pretty funny because John and I look at what we've done and we don't really classify ourselves as emerging. And I'm talking to one of the ladies who is in charge of the Texas pension fund, the eighth largest fund in the world. I had no idea it was that big. And so talking to her and I'm like, so how can we work with you? This is what we've done. And I'm thinking, yeah, we've got a lot of volume and blah, blah, blah. She's like, well, at your size, I'm like, okay. Since you're under 3 billion assets under management, we put you down in this category down here, and you go talk to kind of our affiliate that underwrites you, and then if they sign off on it, we'll co-invest 3 or 4 million each. And I'm like, no, we've got $100 million construction projects, and we've already closed on 27 assets. We've raised all this money. If you're under 3 billion assets under management, this is where you go. So it is humbling, and what we do here versus what we do, quote unquote, on Wall Street, because you're starting to get to those type of people, it's a different look. And we do, John and I are working with a couple family offices right now, and one of them is a family office of family offices, and that's interesting, very interesting, but it's a good explanation.
Just to kind of add to what you and Bernard said, I mean, I think right now this is a time that everybody has to recognize there's a lot of uncertainty and a lot of risk. And so, private equity money, just like syndicated, investors, accredited investors, are looking for, how can I de-risk the investments while still chasing a return? And so it's really, really important to private equity groups as well as to limited partners that they're investing with experienced operators. And so if you are not an experienced operator, or you've got a couple of years under your belt, that's not going to be good enough for PE. But one of the things that we do at Revision Master is we do partner with other sponsorship teams, and multifamily is definitely a team sport, where if you have, a great asset, you're in a great market, but you just don't have the depth and the breadth of experience, reach out to John and Meryl and Bernard and I. And, if the asset makes sense, we may be able to come alongside you, bring our experience, and then, open the doors up to some other investors in PE based on the competencies of the group that's investing.
Anybody else got any thoughts?
I've got one question for Bernard for the benefit of the group. So just as I moved to Texas in 2009, with no friends, no family, I had a thesis. So Bernard, what is your thesis? Why are you leaving your home country of Canada? And why are you moving to Dallas?
He's transitioning, John.
Your fam, not just you, it's your wife and 2 young children. Why are you moving here? Besides the better weather.
Well, I mean, weather plays a factor, but it's maybe about 5% of the equation. But no, it's a great question. Look, and I mean, you were talking about it earlier. You moved. I kind of saw 10 years back, and I'm John. And I think the climate of, especially when I was in New York. New York is where deals get done, but the assets that are generating the cash flow is, in the Sun Belt, and it's especially for multifamily. It always has been, will always continue to be. Now, all these markets are obviously have their different nuances and characteristics. But overall, when you look at it, Texas has the best, overall top to bottom when it comes to employment income, when it talks about in terms of the amount of units that are in the state. When you're talking about the ability to access the capital, whether both on debt and equity. Yeah, capital markets are obviously going through a bit of a storm right now, but real estate's a cyclical game, and you have to expect this. You have to expect the ups and the downs, and that's another thing that that a lot of the institutional guys look for is how you perform in these times. And if you can weather the storm, if you can mitigate all those risks, they'll deploy the capital further down the road from you. So, I mean, not only, the great team that we have at Revision Masters aside, I mean, it's a great bench that we have, the environment for your capital, the assets that you can invest in. It's probably, if not the best in the US. So, I mean, it was a no-brainer, to be honest. That this is not a, wake up one morning and decide. This is probably a decision that I've been contemplating for well over 5 years.
Good deal. My final comment, everybody. One, thank you very much for joining us, continuing to reach out to us. I would strongly encourage you, whether you're an LP or a GP, if you're concerned about how your fund is doing, and you're thinking about doing capital calls, which is, keep in mind, every company agreement that has been drafted since the history of time, maybe not since then, but has had capital call provisions in there. Every agreement does. And there's a reason why every agreement does, because sometimes businesses need capital. I would imagine that 99% of everybody on here that is invested or is a sponsor has non-mandatory capital calls. So you cannot force somebody to put money in, but you can ask. And there's a whole process, and it has to be done right because we're dealing with the SEC at the same time. So whether it was our firm or someone else's firm, before you go down that road and before you start making loans to your company as a GP, talk to your legal counsel. Keep in mind, you make a loan to the company that violates your loan docs. Doesn't mean the lender's going to foreclose, but you need to talk to your legal counsel before doing that, because it does show up on your books and you're going to have to figure out how to explain that. So I can't stress that enough. Everybody will be fine. We're going to weather through this. And if you guys have off-market deals and they're good deals and you can't figure out, either how to raise capital, or you want to bite the bullet and want to partner with us, feel free to reach out to us, because we are in the market. And I know a lot of you guys are too. There are opportunities out there. We wrote 6 LOIs in the last 4 days, and we're about to submit another group. There are opportunities right now, and not all of them are just fire sale. There's some good opportunities out there that make sense. So be safe, and thank you for joining us.
Thanks, everybody.
Thank you.
Thank
See you next
y'all.
month.
Have a good evening.